All right, let's talk about something that can have a huge impact on your retirement savings. A little thing called an annuity cap. We're going to demystify it for you today, so let's dive right in. So here's the classic dilemma, right? You've worked hard, you've saved up, and you want that money to grow. But, oh man, the thought of a market crash just keeps you up at night. Well, that's exactly the tightrope walk that things like fixed index annuities are trying to help you with. Okay, so here's our game plan. We'll start with that core dilemma. Then we'll get right into what a cap is. After that, we'll weigh the good and the bad, check out some other options, and wrap up with how to make a cap actually work for you.
All right, let's kick things off with that big challenge, the one that so many people face when they're getting close to retirement or are already there.
Yeah, this is really the heart of it, isn't it? You need your money to do something, get better returns than just sitting in a savings account. But at the same time, you're at a point where you absolutely cannot afford to take a big hit and lose that principal you've worked so hard for. It's a real balancing act between, wanting growth and needing to protect what you have. So, how do insurance companies try to solve this puzzle? Well, they have this feature called a cap. And a good way to think of it is just like a ceiling on how much you can earn. Let's dig into that. You've probably heard of a fixed index annuity, or FIA. And on paper, they sound pretty amazing. Your money is safe from market downturns, but you still get interest that's tied to an index, like the S&P 500. But there's always a catch, right? There's always a trade-off. And a lot of the time, that trade-off is the cap.
Okay, so what is a cap really? It's exactly what it sounds like, a ceiling. It's a hard limit on the interest you can earn in a year. The market could shoot for the moon, have an absolutely incredible year, but your earnings are capped at that set percentage. It's probably easiest to see this with a quick example.
All right, so let's imagine the S&P 500 just has a killer year. It goes up by a solid 10%. Now, the specific annuity contract you have, it has a cap. And let's see that ceiling is set at 7%. So, what happens even though the market jumped 10%? Your account only gets credited with 7%. Boom, you hit the ceiling. It's important to note, though, that if the market had a more modest year, say it only went up 3%, you would have gotten that full 3%. The cap only kicks in when the market does better than the cap rate. And right there, that's the core bargain. That's the deal you're making. You are knowingly, willingly giving up the chance for those monster home run years in the market. And what do you get in exchange? You get an ironclad promise, a guarantee from the insurance company that if the market tanks, you lose zero. Your return is just 0% for the year, and every penny of your principal is safe. So that trade-off, it sounds simple enough, but is it the right move for your money? Let's break it down and really look at the pros and cons. Okay, on the pro side, a cap is super easy to understand. There's no complex math. And that 0% floor, that gives you incredible peace of mind when markets get rocky. Now, on the flip side, the big con is obvious. You're going to miss out when the market has a really strong year. But there's another risk here, a really important one that we need to talk about. And this is a biggie. It's called renewal risk. See, that really nice 7% cap you got when you first signed up, well, it's not guaranteed forever. Every year, at your contract's anniversary, the insurance company can change it. They can lower it depending on things like interest rates. So that 7% cap that looked so good this year could suddenly become a 4% cap next year, and that really puts a damper on your future growth potential. But listen, a cap isn't your only option. It's not the only game in town. Insurance companies have a few different ways they can calculate your interest, so let's check out a couple of the other big ones. Okay, this chart lays it out pretty well. So we've already talked about the cap rate, right? That's your ceiling. Then you have something called a participation rate. This one's different. It gives you a percentage of whatever the market gained. So if the market goes up 10% and your participation rate is, say, 60%, you get a 6% gain. The cool thing here is there's no ceiling, which is awesome in those really strong market years. And then there's a spread. This one's pretty simple too. They just subtract a flat percentage from the market's gain. So market's up 10%, the spread is 2%, you get 8%. You can see how each of these is kind of built for a different outlook on how the market might perform. So what if you're thinking, you know what? I like the safety of a cap. That's for me. Are you just stuck with its downsides? Not at all. There are absolutely ways to work around its weaknesses. Let's go over a few strategies. Here are 3 really smart ways you can make a capped annuity even better. Number 1, you can add a rider, something called a guaranteed lifetime withdrawal benefit, or a GLWB. This basically locks in a stream of income for the rest of your life, no matter what happens. Number 2, don't put all your eggs in one basket. A lot of these annuities let you split your money. You can put a portion in the capped strategy and another portion in, say, a participation rate strategy. You kind of get the best of both worlds. And finally, number 3, you can ladder your contracts. That just means buying a few different annuities over a few different years. Why? So you're not at the mercy of one company dropping its cap rate on all your money in a single bad year. You know, when it's all said and done, it really comes back to one simple question. There's no best strategy that works for everyone. The choice between a cap or a participation rate or something else, it all comes down to what's more important to you with this money. Is it the rock-solid, absolute guarantee that you will never lose a dime, or is it having the potential to capture more of that market growth? And so that's the final question we'll leave you with, and it's one that only you can really answer for yourself. When you look at your own retirement, what's the right balance? Is giving up those potential home run years in the market a price you're willing to pay to get rid of the risk of the terrible losing years? That's the trade-off. That's the whole ballgame.